The last item I wanted to touch on briefly was the foreclosure short sale issue. And as Desiree had mentioned, the IRS makes their laws based on economic times. Really, it's economy-based, the laws that they pass. And a year or two ago, they realized that the values of homes were all declining, and people, with all these loans that have been given out for people who couldn't afford them, or initially they could afford them, but then a year or two later, when the payments doubled because the rates went up, now they couldn't afford them. They realized there was some not so nice stuff going on, and they decided to make an exception for these taxpayers who couldn't afford their homes anymore. And the IRS, the federal government, said on certain types of loans, these qualified residential mortgages, we're going to let you, we're going to exclude, I think it was $2 million for married, $1 million for single, of cancellation of debt that you wouldn't have to pay tax on, $2 million. Now, I know for California the rules are different. For California, we didn't know for a while whether they were even going to adhere to the federal laws or not. They eventually decided to adhere to it partially. So for California, the rules are, I believe it's $400,000 of debt, of cancellation of debt for single, and $800,000 for married. So it's a lot less. The two common exceptions to, and again, it only qualifies for primary residence, and even in primary residence, it only qualifies for certain types of loans, what we call qualified first resident loans. Basically, it's the money you borrow to buy the house, buy or substantially improve it. For example, if you bought a house for $500,000 and your mortgage, your debt on it was $450,000, and then years ago the values went way up, and let's say you borrowed another $300,000 or $400,000 and used it to pay your kids' education, you bought cars, you went on vacations, it was something other than the improvement or the acquisition of the house, that additional $300,000 that you might have borrowed on a refi, that doesn't qualify for this $2 million or $800,000 exclusion. Because they don't want, the government didn't want people taking advantage and taking out all their money on the house and using it for other things and then just being able to walk away without any consequence. So there's only certain types of debt that qualify. Unfortunately, for investment or rental property, it doesn't fall under that rule of the exclusion. The only two that I know of that will allow you to exclude or not pay tax on that, there's one if you file for bankruptcy. If you actually file a Chapter 7 or a Chapter 11 legally filed bankruptcy, then the IRS can't come after you for the tax on that cancellation of debt. The other option is if you don't declare bankruptcy, but if you are considered insolvent, there are other forms to file with the IRS that shows your insolvency. Really what insolvency means is your debt is more than your assets are worth. You've got a net, in effect, you're in net negative position as far as your assets and liabilities. But there's forms to fill out, there are procedures to follow, and there's a lot of proof to be met in order to qualify for that. Unfortunately, for, like I said, for the rental properties, the investment properties, if you're just walking away, yes.
Are there any deductions on second residences that you can use?
Well, the amount that you're going to get hit with for the debt relief is basically the amount of debt that you're being relieved of that you don't have to pay.
What
so
expenses that you pay to improve the house or maintain the house?
If you've improved or maintained, all that goes into what they consider your cost basis in the home. So that it increases your assets. That will actually reduce your amount of income that you're going to recognize because you've put more money into that house. Your property taxes, interest, that's all deducted as you pay it as you go. So that really doesn't come into play with this debt relief issue. But there are certain things. The more money you put down equates to, the more money you put down on the house, that's the other issue, the less debt you're going to have, which would also create less debt relief.